2016 will be remembered as the year the UK voted to leave the European Union and America voted in Donald Trump as president. 2017, the year Trump becomes president and president with power, with the Republicans having control of both halves of Congress as well as the presidency. Christopher Vecchio, FX strategist at DailyFX, joined us now with more. Chris, how will that translate into the markets?
Well, for starters, the Trump presidency and the Brexit, whether or not it goes through this March, will certainly upend markets, at least the global order that we've seen over the last few years. Certainly one thing that markets have gotten used to since the global financial crisis has been this lackadaisical response by fiscal policymakers to actually go through and implement strategies or policies that actually help the economies grow. So the impetus has been on the central banks. They've really been the only game in town since 2007 or 2008. And now that's probably the biggest threat to markets going forward, that we're going to shake away from this lower bound of interest rates. Central banks will no longer be the game in town, and fiscal policy will be upended in the early part of the year. If it's in the U.S. with tax reform or if it's infrastructure spending, we're certainly likely to see one or both of those come to fruition in 2017. How do I feel like this will translate into markets? Well, with fiscal reform coming down the pipeline in the United States, that's probably going to mean that we're going to see inflation expectations continue to jump, something that hasn't really been the case for the past several years. In turn, higher inflation expectations of the United States translate into higher real yields, or at least real implied yields. And as those go up, that benefits the U.S. dollar.
So which trades do you see as the most responsive to the political developments likely this year?
What trades are going to be most sensitive? I think those that pertain to interest rates, because we see the ECB and the BOJ sticking with policies that are keeping their respective yield curves flat and the short end pinned near zero. Any efforts to stoke inflation pressures, say in the United States, could see long end U.S. yields rise, which in turn should boost interest rate differentials in favor of the U.S. dollar. So as long as that Trump reflation mindset is still there, where U.S. yields are going up, inflation expectations are going up, I'd expect the euro and the yen to weaken versus the dollar. I'd also expect gold to continue to weaken and equities to outperform. But I don't know how long that trade will last. I think ultimately that could just be a short bubble, because Trump's plans may not have the fruit or the meat on the bones that's necessary to keep the momentum going.
So what sort of time periods are we looking at for those trades, and what will it take for you to revisit these calls?
So we get down towards June 2017, I would start to question whether or not the U.S. dollar is able to maintain its levitation. By that time, we should see whether or not Trump's policies for tax reform and infrastructure spending actually have any meat on the bones. And if they don't, that really leaves the dollar in a tenuous situation where the Fed expectation curve has really been lifted by this expectation that fiscal policy response will be a little bit more meaty during 2017. If really that's not the case, all of a sudden the market's going to unwind these expectations for 2 to 3 rate hikes this year. That would pose a significant problem for the U.S. dollar. I myself think that if the infrastructure plans are rumored to be as they are, which would be mostly privately funded, I don't see how those turn or translate into the necessary economic growth that the United States needs. Private investors want cash flows, and schools and sewage treatment plants certainly don't put those out. You may be able to build roads and bridges by levying tolls on them, but consumers don't really like those types of modes of transportation. So I don't really see how that type of infrastructure plan could ultimately result in the economy growing on a sustainable basis. I would be concerned that inflation pressures do build up, particularly if we go down into a trade war with China. And because of the deficit spending potential here with the Republican control of both houses of Congress as well as the presidency. Since 1965, there's only been 18 years in which one party's controlled both houses of Congress and the White House. During those years, the structural U.S. budget deficit, has increased by 0.4 percentage points on average. And so I would think that the U.S. debt rating could come back under pressure in the later half of this year, which in turn may translate into weakness for the U.S. dollar. So yes, while euro dollar and dollar yen may be in the market's crosshairs amid rising yields in the first part of this year, whether or not we can move on to the actual realization of Trump's policy plans and if they result in growth will ultimately be the determinant for whether or not the dollar can sustain its recent rally throughout the course of 2017.
Okay, Chris, thanks. That was Christopher Vecchio, currency strategist at DailyFX in New York.